Good afternoon or good morning, depending on where you are, and welcome back to another members only Q&A session here at Options Play. You guys have given us a lot of feedback here over the last couple of months that we started doing this. So we're back again with Brian and I. We're gonna answer your questions. Many of you have submitted. We got at least over 70 questions already. So we're gonna go through as many of them as possible. We're gonna try to cover the ones that I think are applicable to as many people as possible, so that we're not just answering questions that are that are tailored for a specific person. That kind of everyone can potentially benefit from the answers for those questions. So, Brian, let's go ahead and get started. I'm happy to take the first one. Um, this is a good question. A more broad question, a more general question, and thank you everyone that has already chimed into the chat window saying hello. Please, if you're new to joining, if you're new to Options Play, feel free to chime in into the chat window, say hello, let us know where you're from. As you can see, we have a very vibrant community of traders here. And this is a members only session, so it's a small intimate group. We're trying to get to as many questions as possible. And the first question that I have here is, as professional traders, what are the biggest mistakes you have made? And I think this is probably one that both Brian and I should probably weigh in. And I would say, Brian, a lot of the mistakes that we made were earlier in our career, obviously. And I would say, the biggest mistakes that I've made have almost all exclusively uh, been around, the amount of risk that is taken on a trade. Every other mistake that you make, I think that uh, it's easy to learn from. The hardest ones to learn from are position sizing, knowing how to size a trade accordingly and making sure that you do it the right way is probably the hardest thing to learn. And really, there isn't a quick way to learn that. A lot of people say, like, how do you learn that? And unfortunately, the only way to really learn that is to quote unquote lose a huge amount of money in your portfolio and figure out, oh, that was too much that I risked. I got to start risking smaller amounts on every single trade. And inevitably, you learn that lesson the first time. You go back to trading small, and a lot of times, what I see traders do is when they start getting better at trading, they start learning kind of the ins and outs of trading, and they have especially when people come off of a winning streak. You have 5, 6 winning trades in a row, and all of a sudden you feel invincible. That is when I see a lot of people start to add to size. They think, oh, you know what? I've really got a handle on this. I really feel like I understand how to do this. Now I can start trading bigger size only to get, their portfolios handed to them as a result of that. It's really just doesn't matter how many winning streaks you have or how good you think you are, the markets will always humble you, is the one thing that I've learned. Um, Brian,
All right,
wanna
I'll give two things, and because you obviously went into it in detail. One of the biggest mistakes that I've made, and I've done this, and I still continue to do this from time to time, is be aware that you have a trade on and close that trade. Like, for example, and I talked about this in one of the webinars I did about trading landmines. If you end up on an option expiration Friday, for example, and you are in a long call spread, if you don't close out that long call spread and the stock lands in between it, you might end up buying stock. And so just don't fall asleep. I think that's one of the biggest mistakes that I've always learned, that you have that position on, you need to do something with that position before that expiration date. So be aware of those type of things. That's a simple thing. And then the biggest one is just not closing out short spreads. When a short spread is trading for a dime or a nickel or even 20 cents, and you're just hanging around and hoping to make that last dime on your trade, it's usually not worth the risk. close out those trades. We have rules, inside the OptionsPlay platform. You get alerts inside the daily plays telling you when to close things out. But in general, think about just closing out trades, or else the market can come back and humble you, as Tony said. Those are the two biggest mistakes I think that I always run into. Got the next one, Tony?
Ryan, I'll let you take the next question.
All right. So the next question that I have, and I lost it here just for a second. What is the question? Read it real quick. Like I just lost my screen.
Uh, what do you think about selling in the money cover calls? Some
Yes.
think this covers us for a decline in the stock as well.
All right. So as far as that strategy is concerned, I don't have any problem with it if you understand the strategy. It's synthetically like selling a put option to buy the underlying stock. So if I'm selling an in the money covered call and I own that underlying stock, I obviously want to sell the stock at that strike price, and I got to be willing to do that. Now, what's interesting about that is that you are selling it in the money. So you are saying I'm willing to take less than where the market is at this point in time, but I'm going to get paid a premium for it. So if you're doing that strategy, you got to pay attention to how much time premium you're getting. It doesn't make any sense to sell an in the money call option and capture zero time premium. You might as well just sell the stock and get rid of it. Now, it is a form. If I'm nervous about an earnings report or something, I could do that to bring in some premium and be prepared that the stock could get called away. But synthetically, that is actually the same profit and loss graph of selling a put on a stock that you want to buy. And I don't mind that strategy either. So the only one thing that if you're going to do that strategy, make sure you pay attention to the amount of intrinsic value that's in that call relative to the time premium that's in the call.
Yeah, that's always a question that I have trouble really giving a sufficient answer on because, I'm not a fan of selling in the money cover calls, but I can't really tell you why because synthetically it's the same as selling a short put. And I love selling short puts. I guess the reason that I don't love the in the money cover calls is that you do have the risk that that call option just gets called away, and now you basically have no position in the stock. Versus if you sell an out of the money put option, which is effectively what selling an in the money call option is, an in the money cover call, you have a lower chance of that put option being assigned early. Here's a question here from Medea or Media. What portion of a portfolio would you recommend allocating to actively trading options? And for the remainder, would you suggest staying in cash or more prudent to deploy that capital into ETFs or other passive instruments? So, generally speaking, I would say if you think about most portfolios, there's probably an allocation of somewhere between 20 to 25% of that portfolio towards more active, more speculative investments such as options. And then the remainder, usually in the 70-80% range, are invested in more longer term investments, usually in some type of ETF, single stock, bonds, or what you consider passive instruments. So, the short answer to your question is usually 20 to 30% in more speculative positions, and the rest of it is definitely not just in cash, but in other types of investments. And what type of other investments, that depends on kind of your risk tolerance and your age and what your investment goals are.
All right, I'll take the next one, Tony. I find option strategies with 3 or more legs often hard to get filled. Is it just my broker, or does this happen to everyone? I find that a little bit befuddling myself that you are having a harder time with 3-legged option strategies. If I am entering a trade, and even 2-legged, Usually, if you come to the marketplace as one trade, it benefits you. You're giving the market maker, if that's who you're trading with on the other side, a buy and a sell. And every time you add a leg, it makes it easier for them to protect themselves and hedge themselves. So I don't know who you trade with, and I don't want to necessarily go down that road. But usually, if I have a three-legged trade on, you know what? The answer might be, what are you trading? Maybe the underlying stock isn't liquid enough. Are you trading a little bit obscure stocks that just don't have a lot of volume in it? If I'm in something in any of the Meg 7 stocks, if I'm trading SPY, if I'm trading SPX, I usually have a decent chance of getting a fill close to the midpoint. So I think it might be the underlyings that you're trading, and I'll leave it there. And if you can do it as three legs, do it as three legs. Don't try to leg into them, is I guess my only real suggestion off of that question.
Yeah, definitely. If you think about it, if a three-leg strategy is less risk for you, it's also less risk for the market maker on the other side. So it's usually easier to fill. But I think if you're having trouble like being filled, it's more likely it's because it's in less liquid underlying. And what you're going to probably need to do is move your limit order closer to the natural price and further away from the mid price in order to get filled. Um, the next question here, there's actually a couple of questions that are sort of aligned to the same category. So I'll try to kind of cover them together. There were quite a few questions along the lines of fundamentals. So Dovel asked, often you show four fundamental stock indicators that you look at: forward PE ratio, expected EPS growth, revenue growth, and net margins. Where can one gather this information? Are there any other fundamental indicators you look at, and how should we interpret these numbers as being strong or weak place to trade? So, first of all, in terms of where you can get this information, almost every brokerage firm should be able to provide you that type of financial ratio information. It should be available for free at your brokerage firm. If not, even free sites like Yahoo Finance many times will be able to provide it. And then, lastly, if you need to, you can pay for sources. But I think for most people that have access to a brokerage account, you should be able to access that type of information for free without having to pay for it. Are there any other fundamental indicators that I look at? Yes, but not on every single stock. So these are the four indicators that I look on every single stock investment. And sometimes if there's something about these four that look a little bit funny, then I'll dig a little deeper. But usually these are the four that I must look at on every single trade. And how do you interpret these numbers? So forward PE ratio is what we consider a valuation ratio. That gives me a good sense for how am I paying, how much am I paying for this particular stock? Because, a stock at $100, $200, $300 means nothing, because you have to think about the value of the company divided by the number of shares. And the price simply, the price of the company doesn't really tell you much in terms of what you're paying in terms of value. So what the forward PE ratio gives me a sense for is valuation. The rest of the indicators give me a sense for whether or not that valuation is justified or not. And what I really need to do is I need to compare the valuation to its industry. And what I'm trying to get a sense for is number one, is the stock trading above or below the industry valuation? And is there a reason for it to be trading there? Or is it mispriced based on that? So, and how do I determine whether it's mispriced or priced accordingly is based on whether or not the growth rates and the profitability is higher or lower than the industry, right? So for example, if expected EPS growth and revenue growth is higher than the industry average, then I would expect that the valuation would also command a higher valuation than the industry average. But out of those three metrics, the expected EPS growth, the expected revenue growth, and net margins has the largest weight for me. Because profitability ultimately has more to do with or rather has a larger impact on the valuation than expected growth rate. Keep in mind that expected growth rate is also a a consensus number. It's not a real number. It's really just what analysts expect, right? And analysts are wrong all the time in terms of what they expect. So net margins are true numbers. It's actually how much profit a company has made for every dollar in revenue they generate. So for example, if a company, if let's say the average net margin of an industry is 15%, but a stock has, a particular stock has net margins that are 20%, then I would expect that that company has a higher than average valuation. So what I generally look for are companies where they have higher than average net margins, but lower than average valuation. So, for example, Zoom is an example of this, right? It's currently trading at a lower valuation than the industry, yet it's more profitable than the industry, and that's a disconnect, and that's an opportunity from my perspective. That's a stock that I think is undervalued. Vice versa, if you look at stocks like I don't know, like Penn Gaming, Penn Entertainment, it's trading at 80 times forward earnings. It's well above the industry average. And then you look at net margins, their net margins are negative, which is below the industry average. That's another disconnect. That's an overvalued stock. So that's what I'm generally looking for when I think about fundamentals. Hopefully that, it was a bit of a long answer, but hopefully that gives you better insights into how I think about valuations or how I think about fundamentals. And those are the four indicators that I look at on every single investment to better understand that company from a fundamental perspective.
Excellent. Okay, I'll go to the next one. How can options be used to predict a possible move in the underlying securities? And I think this really goes hand in hand because today is the magic day. We have Nvidia announcing earnings today. So everybody's kind of been waiting for Nvidia to announce earnings. And so I'll go through how you find the expected move on Nvidia ahead of their earnings. The one thing that you want to do is just look at the nearest term expiration, and you look at buying a long straddle. That means I'm going to buy the most at the money call and the most at the money put. Now realize this is not an exact science, but if I look at the long straddle with this Friday's expiration, it's trading for $9.50. And I just pulled that up while Tony was talking. And that means we're looking for about a 7% move on Nvidia going into Friday's expiration. So always realize when people are talking about expected moves and the possible movement of the underlying security, that it's always based off of this Friday's expiration. Now, if this question is predict a potential move in a direction, there's not really anything that will give you it in regards to direction. Some people try to look at open interest and they say this is the most traded option contract, or look at the volume. It's really hit or miss in that scenario. And then there are some people that try to chase unusual activities. They think that if there's a lot of money that comes in and buys this way out of the money call option, that might mean that person is smart. Okay, so besides looking at the potential move of the underlying stock, I don't really think a way to use options to predict where the market is going to go is really feasible. There are some scenarios where people try to use it, but open interest and volume, unless you know what's happening in that person's mind, it's hard to tell exactly what that means. Any other thing else on that, Tony?
Yeah, over the years, there's been lots of research papers on trying to predict equity prices using options. I remember about 15 years back, there was a couple of papers on using volatility smile and kind of the skew to kind of get a sense for positioning of options traders. There was a very loose, I would say, correlation between the skew or the smile of the volatility surface with kind of the directional where the stock ended up going. There was some empirical research, very limited, that did show that. I would say these days, there is a lot of interest in kind of understanding dealer gamma, meaning market maker gamma risk, with regards to short dated options. And that has been able to shown a little bit in terms of like when you're day trading, the fact that when market makers have to hedge a large options order, that does affect intraday pricing. But that's really more so for day traders, I would say, rather than swing traders, right? Because it's not
Mhm.
particularly useful in understanding, where a stock will go. And the last thing, there is some research to show that especially the major indices tend to get pinned at where there's the most amount of open interest on expiration. Those are a few different ways, but again, they all tend to be more shorter dated in terms of how options can be used to give you some insights into where the underlying could go, but it doesn't mean that it tells you where it will go. So I'll kind of leave it at that.
Mhm.
I got this great question here from Bill asking, what are the two most important Greeks to watch and evaluate? Um, by far, the two most important Greeks to understand are delta and theta. Theta because of time decay, right? Whenever you're buying or selling an option, time decay is the biggest factor in understanding, the expected outcome of the strategy, right? If you're buying, time decay works against you, and you have to offset that with the move in the underlying in order to make a profit. Vice versa, if you're short an option, time decay is working in your favor, but you have limited rewards, so that if the trade goes against you, you have unlimited risk or a substantial amount of risk. And that's really, those are the two kind of forces that you're always trying to grapple against, is the combination between delta and theta. And I will say that, if you really kind of dig one level deeper beyond that, then you have to understand gamma, because delta is not a static derivative, or it's not a static derivative. There's a second order derivative called gamma, which kind of changes delta as the underlying price changes. And that gets more relevant these days because we're seeing more and more people trading shorter dated options. So I actually did a webinar on this specific topic just a few weeks ago, I think it was 2 weeks ago, or rather 3 weeks ago, on the nature of buying versus selling options for 0 days to expiration strategies, and just how theta gets put on steroids and gamma gets put on steroids. Those two derivatives get those Greeks get put on steroids as you trade shorter and shorter dated options. So I'm finding more and more traders having awareness and understanding of these Greeks, but I still think that there's a lot more for most investors to learn. So it depends a little bit. If you're trading longer dated options, delta and theta. If you're trading really shorter dated options like 0 days expiration, then gamma and theta, I would say, are the two that I would pay more attention to.
All right. I'll take the next one, Tony. And this deals with the daily play a little bit. With 2% of the portfolio as the max risk per trade, that means having up to 50 trades at any given moment. I'm assuming that's 50 contracts. How do you recommend doing these trades? OCO orders are unreliable given the volatility. Do you recommend setting an automatic take profit and loss based on the underlying price? Okay, there's a lot in this question, and this could be an entire presentation. OCO stands for one cancels other. And here's the thing about an OCO order. If you're doing it, we're putting out daily plays every day, and some of them contain earnings. OCOs are tough if you're entering those orders around earnings. So be aware of when that earnings date is, and the OptionsPlay platform highlights that right in the banner right across the top when that earnings date is. So make OCOs aren't going to protect you very much on gap openings and gap ups and gaps down. Okay. So, do you recommend taking a profit and loss based off of the underlying price? Most of the time, we're looking at the options price in general. If you're doing the underlying price, I might be doing that based off of charting, and because I saw a stock break through support level on the downside, I want to get out of the trade. Now, I don't mind that, but realize that if you're doing it off of the price of the underlying stock, and then that means you have no idea where the options priced are at, and options have time value in them. So we prefer to do it off of the options price, and you basically would say based off of the midpoint of either this spread or the midpoint of this option. I want to send an order to the trading floor. And here's the biggest thing. Very rarely are you going to send these order at market. So here's the moral to my story. And like I said, I don't want to go on this one all day long, but I would want to do it based off of price. So for example, if I did a debit spread and I put in a long debit spread and paid $7 for it, if that debit spread came down and was trading for 350, I would want my order to get sent to the floor if the midpoint was at 350, and then I would also put in a limit order, which is called a stop limit, to try to execute it somewhere near 350, maybe selling it for $3.40 for the entire spread. And there's some platforms that will allow you to do that. But that's the best way, in my mind, to do that trade. And realize if it's around earnings, I'm probably just going to watch it. And I'm not going to try to do any fancy orders. If you do the limit, the stop limit, it doesn't guarantee that you're going to get filled, but you're going to get alerted that the trade got sent to the floor. So at that moment, you want to go in and address that and look at it and see where it's at. So to me, it's more so that I'm getting the alert that the order got sent to the floor. If I get executed somewhere close to the midpoint, maybe a dime or a nickel below, then that's great. If not, I can adjust my trade and go accordingly. And that's, yeah, I went too
Um,
long, but that's a tough one.
no, that's great. There was a lot to unpack in that one question. Here's one question that I get a lot, and that I get asked a lot, and I think a lot of traders are wondering the same question, which is how much can one realistically make a month using options? And whenever I get asked that question, I always say you're asking the wrong question, because the question is not how much money can you make. The question is how much money are you willing to lose in a given month? Because that's going to determine how much money you could potentially make, right? Because you have limited amounts of capital that you can lose. There's unlimited amounts of capital that you can potentially make, but you have limited amounts of capital that you have to risk to try to make that return. So what you really have to ask yourself is how much of my portfolio am I okay with potentially losing on a given month and still be okay with that? Because I'm sure the answer to your question is not, I'm willing to lose 100% of my portfolio every single month. Otherwise, you would go broke very, very quickly. So you have to set a more realistic percentage of your portfolio and say, I'm willing to risk 10% of my portfolio this month or 20% of my portfolio this month and still be okay. It depends on your risk tolerance, because that's a question that's truly that you have to ask yourself, because depending on how much money you're willing to risk, that will determine how much money you can potentially make. But I can't answer the question for you first. How much money can you risk? And that's a question that you have to ask yourself. And I will generally say, there was the previous question that Brian just answered was along the lines of how much risk can I take, right? Generally our rule of thumb is that you should not risk more than 2% of your total account value per trade. And on top of that, a lot of a lot of traders, professional traders will have a total limit that they'll risk for the month, meaning if they lose more than 10% of their account for the month, they stop trading and they don't start trading until the next month. And this follows the same rules as if you were a professional trader, right? What differentiates a professional trader from a retail trader? The difference is that if you exceed your risk tolerances as a professional trader, you get fired, right? If you risk more than 2% of your account per trade as part of your employment agreement, if you ever do that a single time, or maybe if you do it once, you might get you get called into your boss's office. But if you do that a second time, you're getting fired. And trust me, if your firm says you can't lose more than 10% of your total account that you can trade in a single month and you exceed that, you immediately get shut off. Your positions get liquidated, and that's it. That's the difference between a retail trader and a professional trader. So as a retail trader, if you choose instead today to risk 2%, you say, oh, I'm going to risk 5% on this trade. No one's stopping you, right? But that is what differentiates a professional trader from retail traders, and that's why retail traders blow up their accounts and professional traders don't, because they can't blow up their accounts. Their employer literally physically prevents them from doing it. So hopefully that kind of gives you some insights into like how you really should be thinking about managing risk. You should be thinking about managing risk from the same perspective of, if I exceed these rules that I've placed for myself, I'm gonna get fired. That's how you should be thinking about how you define your risk every single time you place your trade, and how you define your risk in a given month.
You're going to fire yourself.
Yeah.
Like that.
I mean, that truly is the difference between a professional trader and a retail trader. There's no other difference.
Agreed.
They don't have access to, they don't necessarily have access to better information than you do. Granted, they're sitting in front of their desk all day long trying to figure out the markets, but they don't have, they're not any more talented than you are. The only difference is that they're forced to abide by risk tolerances that you don't have as a retail trader, and that's why they don't blow up their accounts. That's why they don't have 30%, months where they lose 30% of their portfolios, because they have rules by their employer that prevent them from doing that. And because they prevent themselves from blowing up, eventually, if they keep at it, the upside is there. But the upside is only there if you prevent yourself from blowing up first.
I like it. I like it, Tony. All right. So I'm going to jump in here. I'm going to grab this Netflix one. We usually don't talk about specific stocks, but I want to draw attention to the fact that you kind of answered your own question in that Netflix is at an all-time high and a pullback is likely in the near future. What is the best approach to this trade? Should we sell a bear call spread? Should we buy a long put vertical spread? What are the optimal strikes and dates? Well, the OptionsPlay platform will help you with that. And to me, just the fact that you said is likely in the near future means that you really don't have an outline for it. So to me, if I'm at a precipice in a stock where I think the stock has reached an all-time high, getting a little bit oversold, especially something that has a little bit of volatility like a stock like Netflix, I would prefer to sell the bear call spread in that scenario and bring in a net credit and get time decay on my side and working for me. Now, Netflix, I don't necessarily have opinion on the fact if it's going up or down, in that it's, right now, Netflix is the best looking lady at the dance, right? Everybody seems to love it at this point in time as far as the Meg 7 and everything else. Well, I guess it gets kind of jilted in the Meg 7, but all the other stocks that are around, Netflix has had strong momentum to the upside ever since their earnings report. So with that said, the bear call spread is where I would lean based off of what you said and how you're approaching it. And because of that, we usually recommend going out about 45 days. So I ran into the OptionsPlay platform and I looked at it, the expiration that was chosen for the short call spread, or the bear call spread, was 51 days out. And in particular, if there isn't an earnings report that's in the future, which they've recently announced earnings, I'd like to stick to that time frame. We're going to sell something a little bit more near the money, give you a decent risk reward. Always like to bring in more premium than less, and that's the way the OptionsPlay platform kind of looks at that trade. So usually go out about 45 days, usually sell something where you're bringing in a good amount of premium. And the fact that you say it's likely in the near future, to me means I want to sell something where time decay is my friend. And OptionsPlay platform will help you address the strikes and everything else that goes along with it.
Fantastic. There's a question here that is related to the platform, and I do want to address that. So I'm going to share my screen for 1 second. The question was regarding one of the scans. We have a scan called a CCI trend scan, and the question was just how does that differ from the other ones? So You should be able to see my screen now. And the question was the question was under trade ideas, we have technical trade ideas. So these are technical analysis ideas based. These are buy and sell signals generated off of technical indicators that are under technical ideas. And within the sorting and filtering for these technical ideas, you have trend following, you have CCI trend, and you have counter trend. And the question was just what's the difference between trend following and CCI? So both trend following and CCI trend are in the same category, meaning they're both trend following scans. They're just using different indicators to identify different opportunities. The CCI trend is a specific trading setup that I have used for about 18 years of my trading history. So I've been trading for sorry, probably closer to about 16 years. I've been trading for about 18 years. And for about 16 of those years, I have used this one technical setup called the CCI trend setup for trading uh, Forex, futures, stocks, options, just about every single asset class under the sun. I have traded using this one technical trading setup because it is one setup that works consistently across the board for all asset classes, and it's just one that I've just continued to use. And I've actually done a webinar specifically stating how we create the CCI trend. It's not particularly hard. We're using a 2-period CCI. We're using a long period CCI, a 50 period, and then a 5-period CCI. I'm not going to get into the details on this session, but just to help answer the question, it is a trend following scan. It's just using a different indicator, using the CCI versus the trend following one. We have multiple indicators that we use under trend following. And then I will do one more question at the same time. There's a question here. Actually, you know what? Let me just share my screen because this one is also requires screen sharing. This question is, what does the POW percentage on the OptionsPlay platform mean, and how does it differ from Delta? So this is specifically referring to under the income tab, when you're looking at cover calls or cash secured puts, we have an indicator here called the POW, or the probability of expiring worthless. And this basically tells you what is the probability that the June 20th $86 call, a cover call on Zoom, would expire worthless if I sold this cover call today. And the question is, how does that differ from the delta of that specific strike price? As you can see, the 86 strike has a delta of 0.15. So here's the thing: the delta is not the delta is used by traders to approximate the probability of the option being out of the money at expiration. So when you see that the delta of the 86 strike is 0.15, that's a trader's back of the envelope calculation that we typically use to say that's an approximation that 86 strike has about a 15% chance that it's going to be out of the money at expiration. The POW is a more accurate calculation of the actual probabilities using the implied volatility of the June expirations in order to calculate that. So the two are very similar. I would say that the POW is just a slightly more accurate, it's a more complex and more accurate calculation versus the delta is usually used as a back of the envelope approximation for the same thing.
All right, Tony, I'm going to address a couple of questions that are popping up in the actual Q&A box. David was just asking about a platform seminar. And I know that you have quite a few of them that are out there. And if they sent an email to support@optionsplay.com, I'm sure some of the guys on the desk would be happy to send you a link to a Zoom web or to a YouTube webinar that would cover the entire platform. Do you have any suggestions that go with that? He had a couple of questions in there.
Sorry, are you passing that to me?
And do we have an update on the platform? He said an hour-long update on the platform would be appreciated. That came from David.
Thank you for that suggestion, David, and that is definitely something that maybe we can cover in the next couple of weeks to give you a more deep dive into the platform itself.
Do we have one that we can send him if he and can the support guys send one out?
Yeah, we definitely have one. I believe Philip is on this call and he should be
Okay.
able to pull a old YouTube video. So David, give us a few minutes and we'll pull a
Oh,
YouTube
okay.
link and we'll be able to send that to you.
And then Tony, I want to give you a kudos one because you get credit for this one, and I agree with Joe. Intuit did great after earnings. Would love to learn more on how you chose that one for your earnings navigator. So I got to give you all the credit for that because you're the one that came up with it.
Yeah, so I kind of covered this to some degree in the when I talked about it from a fundamental perspective, right? Intuit is definitely one of the companies that we were looking at from a fundamental perspective that was undervalued yet was grow was I forget the exact numbers. I'll look it up real quick, but I believe Intuit had really fantastic margins, but was trading at a valuation that was basically in line with the industry, yet it had net margins that were substantially higher. Let me just pull that up real quick just so I can reference the correct numbers. Um, yes. Let me see if I can find it real quick. Yeah, they had net margins of 19%, which was higher than the industry average, but they were also expected to grow far faster than the industry average. And they were trading at a rich valuation at the time, or a richer valuation at the time, but it was justified by the fact that they were growing much faster than the industry and they were far more profitable than the average software company in the industry. So that's why we found Intuit. And then the reason that it made it into the earnings navigator, which is a good question, because just because something is undervalued is not enough for it to make it into our earnings navigator. Specifically, what I look for the earnings navigator is I look for companies that are undervalued, that are about to report earnings, that also have strong relative strength, meaning they're outperforming the S&P 500, they're outperforming their sector going into the earnings event, usually as a sign that there's some type of institutional accumulation going into that earnings announcement, and that's what I like to see. So Intuit happened to meet all of those criteria, and that's why we use it as an earnings play.
All right, and then I'll give you a break. And I have a good question here from Stanley. Please comment. Please reflect upon rolling calls out longer that produces cash versus just holding. And Stanley, are we talking about just buying a long call option or rolling a covered call? So I'm going to address both real quick. Like most of the time when you talk about rolling, we're looking at rolling a covered call. And I'm going to point to managing your positions inside my book, OptionsPlaybook.com. There's a section that addresses managing those positions if you want to have some homework afterwards. Feel free, OptionsPlaybook.com, to check it out. But in there, what I reflect on is if you're going to roll, it's very important to not let the stock get away from you. You want to roll when the stock is close to the strike price. If it gets deep in the money and there's a lot more intrinsic value than extrinsic value, it's very hard to roll up and out and get it done for a solid net credit to the account. You're usually going to end up having to pay a debit. So I like to do preemptive rolls if you think the underlying stock might actually reach that strike. And then I also, if it does get in the money, you don't want to get it or get in the money on your short call option. You don't want it to get more than 1 or 2% in the money, or it's very hard to roll up and out in strike. Now, and I also want to address this because I took this time, this is why I wanted to answer this one, Tony, is we recently did a trade in NVIDIA, what is announcing earnings, and we bought a deep in the money call option and sold a shorter term call against it. Well, we're doing these overnight, and we actually got pegged on that. We didn't have the opportunity to roll the position, and it got too deep in the money. So we just took the entire position off and waited for the underlying stock to come down, hopefully, right? If it runs away from us, oh well, we missed out. But in that situation, we just got so deep in the money, we just decided to close that position. And that's mainly because we're just trading overnight. in that scenario. If that stock reaches that strike, and especially if it's a volatile stock, you need to make that adjustment. Now, if it's just a long option contract, yeah, you're okay with rolling it, but you're also okay with just closing it and opening a new position. You don't have to make it that tough on the situation where you're just rolling out a long option contract that is profitable. Feel free to do it that way, but in my mind, I usually will just close out that position and go and buy a new option contract, different strike, different time period, or whatever. On the rolling of a covered call, it's more important to me because I really want to make sure I get it done for a net credit to the account. So I don't want the risk of the marketplace to be in that situation. I guess I'll leave it there. I got a little bit long-winded, but I did kind of want to mention that because that did happen on the Nvidia position. I wasn't happy that that I had to close out the position, but the stock is now still trading at that same level, and we did an earnings call trade on it as a daily play this morning.
Right.
Any thoughts? Any additional thoughts on that?
No, I think you covered that really well. Yeah.
And then
Um,
somebody wants to track covered calls. Do you got the platform up? Want to show how to do a paper trade on a covered call?
sure, absolutely. So let's take a look at
Yeah, that
the
was
let's go.
anonymous attendee is asking how to use OptionsPlay platform to track leap options and covered calls that I purchased.
Sure. Let's take a look at each one of those separately. So let's say you want to buy a leap on Zoom, right? This is a stock that we're bullish on. I particularly like the current setup. We actually got a bullish signal here today because it's pulled back here in the primary bullish trend, and we're looking potentially for a continuation higher. So maybe you want to buy a long dated call option. Let's say we go out to March of 2026 and you buy an $80 call option. One of the things that you can do is in the trade button here, you can add the position to a paper trading portfolio. And if you don't have a paper trading portfolio yet, you can easily create one from this trade ticket. So you can create a new personal portfolio. Let's say we create one called the paper trading portfolio. You click on that. It takes 2 seconds to create that portfolio. And once you have that portfolio created, you can basically add this position to your paper trading portfolio, this March 20th $80 call option. You can even customize the price. So let's say you bought it at $10.50 instead of $10.80. You can basically customize your premium, add that position, and now you can track that position in your portfolio, in your paper trading portfolio. And actually, I did a webinar last Thursday where we went over a bunch of positions and selling positions for weekly income that we're going to cover on next Thursday, where we built this weekly income portfolio that we looked at. So we put in a bunch of positions here. As you can see, some of them are winning, some of them are losing, and we're going to go over those positions in a next week on these positions and show you kind of how to manage those positions. So looking forward to that. But here's the paper trading trade that I just made, that Zoom call that I just bought. The March 20th $80 call option, I bought it for $10.50. It's now trading at $10.95. It'll track the P&L for you. And then what you can do is you can add positions to this. So you can modify this. You can add a leg. So let's say you want to sell a short dated, what did we say? We were going to sell a cover call. So we were looking at maybe selling the $85 calls that expires in June. And you can say, okay, I'm selling this $85 call option expiring in June for 55 cents. I'm going to trade that, add it to my paper trading portfolio. And now what I've done is I've turned my long leap into a poor man's cover call, right? That's what we're talking about here. So now I have the long June 20th, March 2026, 80 by 85 call diagonal, where I'm basically long the 80 calls and short the June 85 calls. And you can track this position here as well. So now I have my poor man's cover call position here in Zoom. So there's a lot that you can do here within options play. You can basically look at existing positions, you can adjust positions, you can close positions, you can do everything in your paper trading portfolio here at options play. And you can create as many paper trading portfolios as you want. So if you want to test out one strategy in one portfolio and a different strategy in a different portfolio, you can do that. And then you can even set up a paper trading portfolio to mimic your actual portfolio, meaning a portfolio that you have at a live brokerage account, because what you can do is you can utilize the alerts that we offer on these positions to kind of alert you on when there's something to do on an existing position that you have.
All right, Tony, and I have a tough question here. Got to answer the tough, the above and beyond ones too. Chris is talking about having a smaller account and looking for trade long call options that are between $500 to $700, 4 months out. Does the platform have tools to help me find good candidates? And I'll start by just saying, well, it goes along with Tony's research and also using the platform. But Tony puts out a research piece a couple of times a week. And you're talking about a scenario that this is speculative. This is tough to go on out and try to accomplish that on a smaller account. But we definitely put the research behind a lot of the stocks to go along with it. And the Options Play platform can help you pick the right option contract. If I'm doing this though, I'm looking to buy something as a surrogate for owning the stock. So I'm trying to buy a little bit more delta. I'm not speculating on out of the money option contracts. The most recent ones that we have done that I've mentioned already on the show, well, I didn't mention one of them, but we looked at the financials because of the financial sector and the way that interest rates are going and the difference between the 10-year and the 30-year and the 2-year and the 10-year, the fact that those are widening. Financial sectors were strong. We did a deep in the money covered call as a daily play on Charles Schwab. I already mentioned the NVIDIA one that we did. So from time to time, we come up with ones that we're a little bit more longer term bullish on and that we're not speculating around earnings. And I want to emphasize this too, Chris. If you're looking at our daily plays, we will mention if there are earnings. And that is a speculative approach on those trades, and realize that obviously earnings brings in another level of risk. So you do probably want to avoid stocks that are announcing earnings in that position. And I guess I'll bring it back to Tony, but I would combine Tony's research along with the platform is the way that I would approach it.
I actually just posted into that Q&A a session that I recently hosted. This is about 6 months ago that I hosted this, but on how to grow your small trading account. My advice to traders who have a small account is to, number one, stick with strategies that have limited risk and limited reward, because that allows you to have full control over how much you can potentially risk and how much you can potentially make. Credit spreads are a great opportunity for small accounts to help grow your account. And one of the things that you can do is you can use the Options Play platform under the ideas section. If you click on the drop-down menu, we actually have a credit spread opportunity report. And what this is doing is it's finding for you the best opportunities from a credit spread perspective. And what you can do is you can just look at the lower price stocks for this opportunity, right? So for example, TMV, now this is an ETF. So depending on whether you want to trade an ETF or not, but you can look through this list and just look for small price stocks. Look at BP. BP is a $29 stock. And what that means is that the total risk on this particular trade is only $120 per contract. So if you're saying you're willing to risk $500 to $700 per trade, then you can easily trade a few contracts of this specific strategy. And then, you look at some of the other ones, like let's look at some lower price stocks here that I can find. Delta, $48 stock. So you should probably trade this for a few $100 worth of risk. Max risk, $378 within your range of your acceptable risk tolerance. So use the credit spread report to your advantage, because you can find plenty of trades that are risking just a couple of $100 to start off with. And those are some great opportunities to get started.
I like the way you went with that one, Tony. I didn't even think about suggesting credit spreads as opposed to just buying options outright. I like that. We got a few more minutes, Tony, before we got to set it up. Do you have any one in particular? We do have Bob. Bob would like to know what settings you use on the CCI. Can you do that one
Yeah,
quickly?
yeah. We use two CCIs, a 50 period CCI and a 5 period CCI. So like I said, I've got a video on it specifically on that specific one. So I suggest that you watch it and how I use those two indicators. Um, I'll cover this one question that is kind of a broad question. Sorry, it is a specific question to a specific symbol, but probably one that a lot of people are asking, which is I'm saying, who asked this question? Jim is asking, is it too late to buy NVIDIA? Um, it's not too late, first of all, to buy NVIDIA if you think earnings is going to do well, right? Uh, the, I happen to like NVIDIA going into earnings, but to answer your question, you have to ask yourself, are you interested in NVIDIA for the short run? Meaning, are you interested in it for an earnings play, or are you interested in NVIDIA for the long run? Because from my perspective, if you're interested in NVIDIA for the long run, I think that the valuation that it's currently trading at is very, very reasonable given the fact that NVIDIA generates about 55 cents in net profits for every dollar they generate in revenue. That is virtually unheard of, right? There's only a couple of stocks in the S&P 500 that have net margins that high. CME and Visa are two of them, which are also stocks that I like. And they're both trading at, I would say, still fairly reasonable valuations. But NVIDIA is actually the cheapest from a valuation perspective that earns 55 cents in net income for every $1 they generate in revenue. And then you look at expected growth rates, and there's nothing that even holds a candle to what NVIDIA is expected to grow in terms of top and bottom line. So the fact that NVIDIA is trading at what is it, 26 times forward earnings
And
is
now it's up a
just
little bit. It's close to 30. I only know that because I put the daily play out this morning, but it's
I
close
see.
to 30 at this point.
Closer to 30 times
Just a
forward earnings,
smidge.
which
Yep.
which I still think, if you think about it, Apple's trading at 29 times forward earnings. Net
Mhm.
margins for Apple is less than half of what Nvidia is doing, and Apple's expected to grow top and bottom line by about 10%, 8 to 10%. Nvidia is expected to grow 30, 40% and has net margins of 55%, yet it trades at the exact same valuation as Apple. So from my perspective, Nvidia, one of the most undervalued stocks, Apple, one of the most overvalued stocks in the market right now.
Mhm. All right, Tony. Well, I guess I could take one last one. Well, I mean, we're at time. Do you got one in particular you want? There wasn't anyone that I had.
I think I'm happy to leave it at the NVIDIA as our last one
Okay.
for today. But I do want to thank our members for supporting us and allowing us to continue to do this. I hope that you guys find value in these members only Q&A sessions so that we can kind of get to all of your questions that you ask us. I know we didn't get to answer all your questions, but we did get to answer a lot of the questions that you guys submitted ahead of time. So please, the next time we host these sessions, please, the second you get those emails saying put in your questions, let us know, because we do take these questions in chronological order. So the sooner you submit it, the higher the probability that we have on answering your questions. So thank you so much. I hope you guys have a great afternoon, and I'll see you guys here on the next session.
All right. Bye, everyone.